Today, we're talking about tariffs, and the situation is very fluid. Now, as of the recording of this video, President Trump has paused the implementation of tariffs on Canadian goods until really the early March. But we're still in this will he or won't he situation. So, to help us understand the situation, we have with us Carolyn Kwan. Carolyn is a portfolio manager at Connor Clark and Lunn, who manage the Steadyhand Income Fund. And for those of you who watch our videos more frequently, you've probably seen Carolyn before. Welcome back, Carolyn.
Thank you, Salman. Nice to be here.
So, let's just set this up very simply. Take us through what is a tariff and who actually ends up paying the extra 25% if these tariffs end up being implemented.
Yeah, well, a tariff is simply a tax. It's a tax like we pay on things that we buy, like the goods and services tax, a GST, or it could be like a tax on what we make, like an income tax. A tariff is paid by importers. So these are businesses that bring in goods from other countries. And in this case, the tariff proposed by the US is imposed on Canadian and Mexican goods as it crosses the US border. Now, this definition really goes to the second part of your question, which is who actually ultimately pays. And so initially, as it crosses the border, the US businesses will pay the actual tariff. But of course, each business then has to make decisions on what they do with that. Either they can choose to accept smaller profit margins, either they don't increase prices or they increase prices by less than 25%, or they pass it on entirely to consumers, either by raising selling prices in its entirety or some combination. Generally, though, some of it does end up being paid by the end user. So it's consumers that do end up paying for at least some of that tariff.
Got it. So, we are a trading economy, right? We export a lot of stuff. So, are there certain areas of the Canadian economy and the Canadian market that are maybe more exposed to tariffs, and vice versa? Are there some that are less exposed?
Well, Canada is a very open economy, which is to say that we do trade with a lot of other countries. And right now, President Trump has targeted goods crossing the border. And so the parts of the Canadian economy that are most exposed are those that have very integrated supply chains. And this is a case where products will cross the border multiple times as it gets assembled. And so it's not just end goods that are taxed, but it's intermediate inputs as well that go into making these final products. So cars are the best example here. Auto parts get taxed in the assembly, but really, it does occur elsewhere. So, in areas like oil and gas or machinery, there are other highly exposed industries that are across all of the sort of goods sectors, including metals and food and beverage and clothing and wood products. The list goes on. On the other side, areas that are sectors that are maybe less exposed are perhaps the can be characterized as the services sector, really. So these include companies that are in the retail sector, in tourism, in arts and entertainment, healthcare, software, et cetera. So these are ones that are not being targeted at the moment by the tariffs.
So we've been so some might be less impacted, some might be more impacted, and that's really what a lot of the conversation has been about. But is the tariffs that the US may impose on Canadian goods and maybe the retaliation, is that good for any Canadian industries at all?
Well, it's interesting. We are seeing a bit of a patriotic pushback. There are waves and suggestions of Buy Canada on social media and in the news. Um, People are saying that they are looking for Canadian products or wanting to vacation in Canada or at least outside of the US. This is, of course, a very complex issue, though, because there are many US companies who produce in Canada for the Canadian marketplace. And so avoiding a US company may actually end up impacting Canadian workers. But there's also talk, finally, of starting to have some of these hard conversations that around a couple of issues that have really long been a problem in Canada. The first one is interprovincial trade barriers, and the other one is our own lack of productivity in the economy. So some examples of the types of interprovincial trade barriers are things like when you have licensing for a professional, and these can be done for one province but not recognized by a neighboring province. Other examples are companies that sell, for example, alcohol across provincial lines. That's actually quite difficult to do. So if you're a brewery or a winery, you actually can't sell to a consumer on the other side of the street in the next province. And the same thing with safety regulations. And there are a whole number of these types of trade barriers that make it actually difficult for Canadians to operate in Canada. And so if we can reduce that, that would help develop Canadian businesses. A second issue is our country's productivity, and this has been recently highlighted by the Bank of Canada as a national emergency. And productivity growth is important for Canada and Canadians because it helps grow our real incomes. And so maybe these tariffs are another another situation that will actually cause us to look a bit more inward and spur the government to help put in place policies that will aid businesses in investing and deciding to invest in Canada and improve our overall well-being.
Yeah, it'd be great. I mean, if this changes some of the conversation and helps us prioritize and helps our policymakers prioritize productivity, which has been long mentioned as a real difficult issue here at home. So okay, so we've got these different impacts going on. Maybe just summarize for us what is the overall impact that we can expect from this?
Well, the direct impact is actually quite clear. We have slower economic activity, higher unemployment, and also, unfortunately, higher prices. And so, just a little bit more detail here. There have been actually a number of estimates modeled out by, our central bank, by charter banks, by research institutions, and they all kind of agree that there is going to be a negative impact to our output. And so, if we have tariffs in place, 25% across the board, and we have retaliation, the average impact seen in some of these studies is about a 2.5% decline in real GDP for 2025 and another hit again in 2026. So if the tariffs hold for this year, it is likely we will be in a recession. By the way, the US is imposing this, but tariffs are not neutral to the US economy either. They will also see a decline in economic activity. In fact, the US Tax Foundation Research Institute in the US estimates that they will see a hit to their GDP by about 0.5% and garner an amount of taxes totaling about $1 trillion, and that's about $800 per household, and that's for this year. It's actually interesting to note as well. Tariffs are tools that can be used for different reasons. In this case, I think the U.S. president is looking to achieve other goals like border security. However, historically, they have generally been used to try to target unusually large trade deficits by a country. It's worth noting that between Canada and the US, that's simply not the case. It is true that Canada does run a bilateral trade surplus against the US, and the US has a deficit against Canada. But excluding energy, it's actually reversed. Canada is, in fact, the number one destination for US exports. So, in other words, Canadians buy as much from the US as we sell into the US market. And we are very highly integrated economies.
And I don't think that's something that a lot of people, even in the States, possibly even policymakers, appreciate, is that yeah, there is a trade deficit, and deficit exists for a reason, but you exclude energy and we're pretty close. So we've talked about the economy in general. What about currency? What about our Canadian dollar?
Well, if tariffs are indeed imposed, we can expect the Canadian dollar to weaken against the US dollar. And, in some ways, it is actually the job of a flexible exchange rate, a flexible currency to move and absorb the shocks that come from some of these external surprises. So when we have a negative shock like tariffs, the currency should decline to limit the impact on both US prices as well as on the Canadian economy. I mean, a lower Canadian dollar helps our exporters' competitiveness. So as we began this year, we already had a weak currency to begin with, partly as the Bank of Canada over the last year has been cutting policy rates more aggressively than the Federal Reserve has. So the Canadian dollar has declined to about 68 to 70 cents in that range. And there are many strategists out there who think that it could fall to about 65 cents mid-year, and we think that that's pretty reasonable. It's also worth noting that we often compare the Canadian dollar against the US dollar. Quite reasonable. I mean, they're our largest trading partner. This is very normal. But outside of the US dollar, the Canadian dollar has actually been relatively stable. The Canadian dollar is not uniformly stable against every single currency, but if we were to look at the Canadian dollar against a basket of currencies weighted by the value of trade that we do with them, yes, we have seen a decline. However, excluding the US dollar, we've actually been in a fairly tight range of about 122 to 126. So the Canadian dollar is actually on par with countries around the world, other currencies around the world. It's really against the US dollar that we're really aware of and sensitive to the decline.
Yeah, I think that's really helpful context. We do naturally compare to the US, and I don't think a lot of people understand how our currency has responded to this and how it relates to other currencies around the world, other major currencies. So let's talk about the fund that you help manage, the Steadyhand Income Fund. What have you been doing to prep for some of this stuff, and maybe what are you doing now that we have a little bit of clarity what's going to happen, at least over the next few weeks?
Yeah, we're in a little bit of a reprieve right now, and there is still a great deal of uncertainty to come. Setting up for all this, coming into the year and knowing the inauguration is on its way, and that there were lots of discussions about the tariffs. We had, even prior to the weekend, in the weeks leading up to this, on the equity side, we had been managing the risk in terms of the potential tail risks to the portfolio. So in preparation, we were looking for companies in the fund with higher risk to tariffs. So those that, for example, manufacture primarily in Canada and Mexico and sell primarily into the United States. And so there weren't that many that fit that type of profile in the income fund. So we were fairly comfortable. But as the news of tariffs come into place, alongside that theme, we, as we get more certainty and clarity, if they actually come to pass, we can consider additional steps further down to assess companies' exposure, their revenue exposure to different countries, across the three, Mexico, Canada, and the United States. And so if we have, for instance, a similar forecast for what we expect a company to return, but their exposure to revenues is, for instance, higher to Canada than Mexico, we may reduce that weighting and find in a company that we have a similar forecast on with more exposure to the United States. And that is because we believe the United States economic conditions are resilient, are strong, and will be less impacted by the tariffs than Canada and Mexico. So we can make some of these shifts on the margin. And the purpose of all this is to reduce the overall tail risk in the fund. That's the equity side. On fixed income, we believe that many of the risks relate largely to things like higher deficits in Canada. We're going to see that from both the federal government as well as provinces as they continue to provide some support to businesses and consumers. And that will imply higher, longer-term interest rates, for instance, and potentially even wider provincial spreads. But this may also create a situation where the Canadian economy will weaken. And as a result, the Bank of Canada could in fact be ready to cut rates even more, provide some more stimulus to the economy. And so we may see lower interest rates at the shorter term. But ultimately, there are lots of announcements, lots of concessions, lots of retaliation that we really have to work through and be very careful in assessing the situation and managing the risks and opportunities.
Thanks for that, Carolyn. Maybe to end, Carolyn, what should Canadian investors be thinking about right now? What should they be paying attention to? Because there is so much information or rhetoric or whatever you want to call it out there right now. So what should investors key in on, or try to key in on anyway?
Yeah, it is. It's difficult. I mean, as an individual, as a Canadian individual, we we see the impact of tariffs through a number of different ways. We see them as employees, we see them as entrepreneurs, we see them as consumers, we see them as investors. And so, as an investor, one of the things we do want to do is look for ways to protect ourselves, our portfolios, and achieve good returns, and at the same time, reduce risk. And so, one way to do that is we want to look and respond to actions and not words. There are a lot of words, as you say. It's worth acknowledging that even in this past week, where we've seen tariffs imposed, the executive order was actually signed, only to be rescinded later on. So we were right to look at taking action, because this is, in fact, something that did occur. We also know that over the next 4 years, over the term of this next administration, there will be more to respond to. And so we'll be doing this cogently. An additional way to sort of think about how to protect portfolios is to diversify. And this could be across things like regions, across sectors, across asset classes. And so historically, for instance, bond returns have moved in the opposite direction of stock returns. And so that has allowed individuals that own both in their portfolios to capture upside, but also protect on the downside and reduce volatility over a market cycle, and allow for a smoother pattern of returns.
I think it's worth reinforcing that that's what we're doing in the Steadyhand Founders Fund as well. If you had a chance to watch our annual update, you would have seen that we were diversified by sectors, regions, and types of ideas as well, and of course asset classes. And right now, as Carolyn mentioned, bonds play an important part of the portfolio, given the potential moves of interest rates in response to some of these tariffs and the economic situation. So in the Founders Fund, we have a full weighting of bonds today, just to provide that, as Carolyn mentioned, diversification to our clients. Carolyn, thank you very much, as always, for helping us navigate this evolving. Every day is an exciting day, it feels like. Frankly, I wouldn't mind a little less excitement on this issue, but it is. But thank you for sharing your thoughts with us, and to our viewers, thank you for watching.
It's a pleasure. Thank you.